right, welcome to the Multifamily Investor Nation webinar series. Today we're going to be talking about the importance of cap rates in apartment syndication. We're going to probably spend about maybe 15 to 20 minutes on this topic, and then we'll wrap it up here. We'll probably take a few questions at the end. But one thing I do want to mention before we dive into that is about our event coming up in June, MFINCon 2022, June 23rd, 24th, and 25th in Charlotte, North Carolina. If you have not signed up for this yet, make sure you go to mfincon.com to get your ticket and lock in the price, your price for the tickets. And we have some celebrity guest speakers that we've already announced on this one, which is going to be, we have already announced Jocko Willink, who will be live in person speaking on stage, along with Barbara Corcoran, one of the famous sharks from Shark Tank. And then the third, which is going to be announced later today, which I'm going to share with you right now, we have secured, drum roll please, we have secured Shaquille O'Neal. So Shaquille O'Neal, yes, Shaq, the person in person, is going to be there for the event, speaking and talking about a lot of his background as it comes to investing. So really excited to share with you about Shaquille O'Neal coming in and being a part of this event. So those three celebrity guest speakers are going to be Jocko Willink, Barbara Corcoran, and Shaquille O'Neal. So make sure you go to the website mfincon.com, register for the event, and be ready to be amazed at this particular event. We're excited about it and looking forward to sharing a lot of things with you. Just to share with you just a little bit about myself before we dive into it. I'm one of the managing partners of a group called PassiveInvesting.com, which you can go to our website, PassiveInvesting.com, to find out more information about us. One of the things that you can also do is go to Meet the Team, and you can also click on my name here, Dan Handford, to find out more information about myself. And there's a video there that kind of shares with you a little bit more details instead of me having to go through and explain it to you on a webinar each week. So I am married. I'm with my wife, Danae, along with our 4 children, 3 girls and a boy. Matter of fact, I have ones that have an 11-year-old, a 10-year-old, a 5-year-old, and a 4-year-old. I live here in Columbia, South Carolina, so just south of Charlotte. So you can find out more information there about us. And then if you want to look at our other team members there, you can obviously do that. We have our 3 managing partners here. We have our investor relations team, investor services team, and then our marketing and events team. We also have our acquisitions and asset management team, of our self-storage acquisitions, our finance team. We also have our rehab wallet or our real estate debt fund team there as well. And we also have our car wash division that's growing as well, headed up there by Cameron. So very excited to see our team growing. We're at about 34, 35 full-time team members here at PassiveInvesting.com. If you're interested in joining us on some of our future opportunities, you can certainly go to our website. On the top right-hand corner, there's this Join the Passive Investor Club. You can fill out a form there, and one of our investor relations team members will jump on a phone call with you, discuss your investment goals to see if our group is the right fit for you. You can also peruse some of our current offerings available. We have our Mariner Grove asset that is available out of Savannah, Georgia, and is closing in May. And our self-storage fund and our real estate debt fund, you can go there and find out more information. And you can also go to our properties to see our current holdings in multifamily, self-storage, express car wash space, and then we also have some hotel deals that will be added to this shortly as well. We do have a couple of those that have been verbally awarded to us that will be hopefully releasing very soon. So back to the topic that we have at hand here, which is the importance of understanding cap rates. So sometimes this cap rate discussion can be, I don't want to necessarily say misunderstood, but misinterpreted, or people are miseducated or not educated properly on the topic of cap rates. So the first question we need to ask is, what is the cap rate, right? The cap rate is actually a shortened, abbreviated word, cap, for capitalization, the capitalization rate. And basically, the cap rate is a number that allows you to know that if you paid cash for the property, how much money would you make off of that investment every year? So if you bought a 10% cap rate of property and you paid $1 million for that investment, then you should be cash flowing about $100,000 a year off of that investment. Now, most people don't pay cash for the investment, and so they're going to use some form of leverage, and so their returns are usually higher than the cap rate, right? Or they should be if you're using a proper amount of leverage and a proper amount or getting proper or good terms for the debt that you're trying to put on the property. But the way you calculate the cap rate is you take the overall value of the property, and what you do is to try to figure out how much cash flow you're going to make off of it, is you take that $1 million and you multiply it by the cap rate, that 10%, right? That's going to give you the cash flow that you're going to receive off that investment if you paid cash for the property. And it's basically, it's a way for us in the market to be able to normalize and come up with a value of a property based on maybe some other values of other properties in the marketplace, right? Because with multifamily, we don't value the property based on a competitive set, right? We don't go and say, okay, like on single family, you say, okay, that house over there has these X, Y, and Z features, and so it's sold for X per square foot. And then this house over here did the same thing, and this house over here, and you come up with a per square foot and multiply it by the square feet in your house, and now you've come up with this valuation of your property based on the competitive set around you. Because multifamily is a different animal, and it's not just multifamily. Cap rates are used in pretty much all CRE, commercial real estate, across the board. But what you have to really fully understand is the power of the cap rate. That's what we're going to talk about a little bit further today. And so again, if you want to figure out how to figure out what the cap rate is, you take the net operating income of the property, and you take the value of the property, what you're actually going to pay for it, and that is how much you actually can actually that's how you can figure out the cap rate, right? So you take 100,000 of NOI, you divide it by the cap rate, which is say 10% in that other example, and that gives you that $1 million valuation. So as long as you know all those different factors and what the formula works, you can figure out if you got the NOI and you know what the cap rate is, you can figure out the value. Because if you have the NOI, 100,000, and you multiply by the cap rate, which is 10%, you know you have $1 million property. Now, if you have that same $100,000 NOI, but the cap rate is now 5%, now the value of the property is $2 million. And that's one thing we want to make sure that we talk about later on, is the power of the cap rate. Now, the next question here on the screen that we're going to go over is, should you buy in a high or a low cap rate market, and why? Well, when you buy in a high cap rate market, it usually is going to be some sort of lower end secondary or tertiary, maybe even a quaternary market, where in order for people to be attracted to that market and for people to be able to sell their assets, they have to increase or decompress the cap rate of in that market to attract investors in that particular market. And so you have a higher cap rate in that market, because the higher the cap rate, the lower the valuation, but the higher the return for the investor. Now, on the opposite, the lower the cap rate market, the lower or the higher valuation, but also the lower return overall. But if you understand the cap rates and why they are set, it's based on demand, right? And so if you're buying a property and you're buying in a high cap rate environment, you're buying in a market that does not have a lot of demand. So what that means is that if you buy in a high cap rate environment, then you're gonna most likely sell in a high cap rate environment, because you have to increase the cap rate in order to attract enough people there, enough investors there to be able to buy into that particular asset. So my recommendation is, well, before I go over my recommendation, let me kind of go over one thing that I hear a lot from a lot of, quote unquote gurus that try to teach you about cap rates. What they're trying to teach you is how to buy properties, right? And so they'll try to teach you to buy in high cap rate markets. Well, the problem with that is your competition when you go to sell is going to be low. And so you don't get this really big bump on the back end when you put all this time and energy and effort to increase your net operating income. You will get a little bit of a pop because you're increasing the net operating income, but you don't get as much in a high cap rate environment as you do in a low cap rate environment. So let me give you my thoughts on this and kind of what the example I'm going to give you is here. So if you buy, let's just normalize things and say we're buying two similar properties. They're both, let's just say, middle of the road Class B assets in a 5% cap rate market versus an 8% cap rate market, right? And let's just not worry about the value of the property in the beginning. That doesn't really matter, right? All we're trying to do is where can we maximize return? And so let's say we put the same amount of time and energy and effort in a high cap rate environment, that 8% cap rate environment, and the same time and energy and effort in a 5% cap rate environment. Well, we've increased now with that same time and energy and effort in both markets, the net operating income by $100,000, right? Well, if we've increased that net operating income by $100,000 in an 8% cap rate market, take that $100,000 increase in the NOI, divide it by the 8% cap rate environment in that market, and you've increased the value of that property by $1.25 million. That's great, right? You're thinking about that. You're patting yourself on the shoulder going, great, I did a great job. However, if you'd have taken that same amount of time, energy, and effort and did that same thing in a 5% cap rate environment, we did the calculation earlier, you're now at a $2 million increase in valuation. So just by making sure that you're in a great cap rate environment, you've now increased the value of that property exponentially more than being in a high cap rate environment. So my recommendation to you is to always buy in a lower cap rate environment, because it will make sure that you have a lot of competition when you go to sell that asset. Now, is it harder to buy assets in a lower cap rate environment? Yes, absolutely. But that's because there's a lot of competition. And for me, I want to make sure that I have a lot of competition, because when I sell the asset, I want there to be a lot of competition of a lot of people wanting to buy my asset. And so you have to make sure that when you're buying assets, you're thinking about the exit in mind and not always thinking about the here and now, or not being able to look at the competition of the sellers, of the buyers that are going to be in that market when you go to exit that particular property. So again, my recommendation is that you buy in a low cap rate environment, and then you sell in a low cap rate environment, right? Now, obviously, if we can buy high cap rates and sell in low cap rates, that's great. But those are very, very hard to find. But when you find those are obviously great things, great strategies to do. But especially right now, with the current state of the market here in April of 2022, cap rates have been driven down tremendously in a lot of different markets. And even in some of these tertiary markets, these cap rates are being driven down. And when there is some sort of price correction, if you will, what's going to happen is in some of these tertiary markets where maybe you bought at a 6.5 or a 7% cap rate, you're thinking you did a really great job because you're in a 7.5% cap rate environment. But what's going to happen is that when the market starts to shift and you try to sell that asset, you're now going to have to sell at a higher cap rate than when you bought it, and that's a big no-no. You don't want to do that. You don't want to buy low and sell high in a cap rate scenario, right? Because that's going to really have a tremendous impact on your overall returns and potentially be upside down in the property as well, depending on where the market conditions are. So this third thing we're going to talk about here is, what are blue chip corporations? So blue chip corporations are corporations that are publicly traded, well-known companies that are pretty much everybody knows, like Xerox or Starbucks or Amazon or Facebook or Intel. A lot of these companies are blue chip corporations, publicly traded entities, and they are what creates stability in a market. And the reason why a lot of markets like those companies coming to their city and they stump for them is because it also creates increased demand for that particular market. And so increased demand causes a driving down of cap rates, which causes an increase in valuations of properties across the entire market. And that also causes tax revenue to go up, because when the values of properties go up, the value of how much revenue, the amount of revenue that these municipalities municipalities get to collect goes up as well, which is why so many cities try to stump for these large corporations to come to their market to create some stability in the marketplace. And again, that's why they are so significant to cap rates, because they do create jobs. They do create a lot of extra and not just jobs by the corporation coming there and hiring 1,000 people, but those 1,000 people that got hired on also need hairdressers and restaurants and dentists and medical facilities. There's a whole ecosystem that's created around new companies coming in and creating thousands and thousands of jobs for that company. There's also ancillary jobs and businesses that can be created around that particular company as well, which is why you have a significant impact on those cap rates. So hopefully, I got down now to the power of the cap rate, and we kind of already discussed that, right? We talked about how buying in a high cap rate environment is not good if you're trying to increase the value of the property and sell it in a 3 to 5 to maybe 7 year period of time. Now, if you're the type of investor that just wants to go in and buy a property and hold on to it forever, maybe a high cap rate environment is good for you, because if you're never planning to sell and you just want to get a high cap rate and have a stabilized income, then great, you can certainly do that. But that's not what I recommend people to do. It's not what I prefer to do, because you can exponentially increase your net worth faster by buying in a low cap rate environment, improving a property, and then selling it in that same low cap rate environment and having larger valuation increases based on your particular efforts on that property. All right, so that's all I had to cover today. Hopefully you guys were able to gather a lot of information here. I will open it up and see if there's any questions for those of you who have joined us live. If there's no questions, I'll wrap it up here in just a few moments. But the cap rate is definitely something that is fully misunderstood quite often, and it's very, very good for you to fully understand the power of the cap rate and what causes cap rates to be high and what causes cap rates to be low. And so while you're thinking about it, though, make sure that you don't forget to go to mfincon.com and register for the Multifamily Investor Nation Convention that's coming up June 23rd, 24th, and 25th. I do have a couple of questions that kind of come in here, and so we'll talk about this. We'll talk about a few things of these questions. I'll take maybe 2 or 3 of these questions, and then we'll wrap it up for the day today. So Jay's asking, what cap rates are you seeing? Well, I'm seeing cap rates all over the place, depending on the market, right? Most of the cap rates have started to compress and come down, which is good for people who are selling. It's also good for people who are buying, as long as you can buy in that low cap rate environment and then sell it in a low cap rate environment as well. However, what we're seeing in a lot of these primary markets is cap rates are starting to inch between about 3 to 4%. And some of these primary markets where, say a year ago, they were at 4.5 to 5%. We're really starting to see them start to compress a little bit. I've even seen some of them go below 3%, depending on the market. And it's something that, honestly, I predicted about a year and a half ago, where I predicted that we were going to start to see some of these cap rates starting to compress, even to what we're seeing in some of the northeastern states, as well as on the western side, where we're seeing cap rates compressing quite low. Let's see, what is considered a low cap rate, and is that depending on the MSA location? So most primary markets right now, primary MSAs are going to have cap rates that are going to be anywhere between, I would say, anywhere between 3. Well, if it's a northeastern state, or even in California, you might even see sub 2% cap rates, but even in the 1% range. But most of them you're going to see are anywhere between about 3 to 5% right now. Probably more like 3 to 4 to 4.5%. And once you start to get into the higher end secondary markets, it's going to go to about maybe 4.5 to 5%. And then some of these lower end secondary and tertiary markets are going to be kind of that, kind of 4.5 to 5, maybe 5.5%. So they're very, very tight right now in the market. But as we start to see some price volatility, which we're already starting to see that right now, we're going to start seeing some of that the delta changing, and it's going to be quite interesting to kind of see what happens to some of these particular properties that are out there right now. All right, let's see here. What is the hottest area, lowest cap rates in the U.S.? So California, I would have to say, is probably the has some of the lowest cap rates in the market right now, and that's because of the I don't really know what it is because of, but there's a lot of demand in those markets, right? Just like we talked about earlier, low cap rates are caused because of demand. And so because there's a lot of demand in those markets, it does drive those cap rates down. But it's been low for quite some time now, and has been pretty stable in the low cap rates scenario market. So there's been quite a few of you asking about what is the impact with rising interest rates, and how will that have, what kind of impact will that have on cap rates in the future? So I'll wrap it up by talking about this particular topic here, and we'll close it out for today. So as interest rates can start to rise, the typical trend is that because interest rates are rising, cap rates will also rise as well. And because you see that in the past. And I think you're going to continue to see that even right now as we start to see some of the interest rates starting to rise. You are going to start to see the cap rates go up slightly. I don't think it's going to be a significant jump. We're going to see it go, 100, 200 basis points or anything like that. Now, in some of the tertiary markets, you might start to see that, but in the stable primary markets and the higher end secondary markets, I don't believe you're going to see it that much. You're going to see maybe a 20 to 30, maybe 40 basis point increase in the cap rates, which will change valuations slightly, but I still feel like we're going to have a leveling off or a maintaining of the existing cap rates for quite some time. I don't think we're going to see, and the main reason why is because there's still a lot of demand out there. So there's still a lot of capital in the market. There's still a lot of people driven into these different markets that are causing the demand for these particular properties. So there is, multifamily is a very stable asset class, which is why a lot of people, a lot of institutions want to invest there. Well, thank you so much for joining us here today. It is coming up right at 11:30 a.m. Eastern, and I do need to jump to another meeting here, but want to thank each one of you for jumping on, and hopefully looking forward to seeing you and meeting you in person and shaking your hand in Charlotte, North Carolina in June 23rd, 24th, and 25th for the Multifamily Investor Nation Convention, June 23rd, 24th, and 25th. If you haven't grabbed your ticket yet, go there now, grab your ticket. Looking forward to seeing you here next week. And next week's topic is going to be about breaking down the PSA, purchase and sale agreement for apartment syndication. That's going to be Brandon Abbott, and he'll be listing out some topics there a little bit later. But go to the website there right now and register. Look forward to seeing you next week on the Multifamily Investor Nation webinar series.